Hey guys, and welcome to today's training video. Today we're going to be discussing price action strategy. Today's strategy, I'm going to be showing from start to finish how to analyze the forex market and to better time your entry and your exits in the forex market. What I'm going to be discussing here today is what I learned, a formula I learned from my mentor, all he has taught. So I'm going to be showing you how to do it from start to finish, how to profit in bull and the bear market. So all I want you to do is pay rash attention. If you are new to this channel, subscribe to this YouTube channel, like our video, turn notification post on so you don't miss any of our videos ever again. And also I also like you to get a jotter or a pen and make sure you jot down this formula, any key points you like. So if you have any question, you can leave it in the comment section below. I'll be sure to respond to your questions and give you a vivid answer that will help you profit in the forex financial market. Mind you, this strategy can be applied to the stock market, the futures market, or any other financial market you decide to trade. So the overview of today's class is the market structure, the area of value, the entry, and the exit. So summary, the formula is the MAE formula. That's M-A-E-E formula. Good. That's the market structure, the area of value, the entry, the exit. And I know class, you know that I'm going to give you a summary of all we learned on this channel and also a bonus tip. So just pay us attention and let's get started. So the market structure, for those of you that have been following our YouTube channel, you know that I discussed the 4 stages of the market. So these are the points of when you at this point you have to pay attention to what stage the market is in currently. Is it in an advancing stage, a distribution stage, a declining stage, or an accumulation stage? You agree with me that the advancing stage is a stage that follows after the accumulation stage. You want to say why the distribution stage is a stage after the advancing stage, the declining stage is a stage after the distribution stage, and the accumulation stage is a stage after the declining stage. So we're going to go to the forex chart and see how to identify this. Then we'll move forward with the analysis. So this is the Euro USD, the daily time frame. As you can see now, the market is in an uptrend, but at this region here, it has hit somewhat like a distribution stage. So we have this bias, okay, that is more like a uptrend known as the advanced stage. And at a point in the market over this region, it's like the market has hit a distribution stage, but we are not sure about that. But what is more obvious here is the advancing stage that we can see over here, which is from this point over here to this point over here. So it's likely that this market will continue upward. You want to say this could just be a partial retracement to continue forward. So we are not yet certain on what kind of whether it has actually hit a distribution stage. But what I can see here, I can see clearly an advancing stage. Good. So now let's get back to class. So moving forward, after the market structure, after we have identified the market structure, we're going to look towards to identify the area of value. At this stage, to identify the area of value on your chart, it means you need to identify your key area levels known as the support, your resistance level. Either you are using the moving average, the trend line, the Fibonacci level, and etc, etc. There are other things you can use to identify these key levels, key area levels in the market. So now we're going to go back to that chart now and identify the area of value, the key area levels in that market. So, and with this, it will clarify us on what kind of stage of the market it is currently. Good. So now over here we have the advancing stage, as I said earlier. So we're going to just identify key area levels in the market. Like this is obvious here. Here is obvious. Here is obvious. Here is obvious. Here is obvious. Here too is obvious. So as you can see here, if you take the chart backward, you see that this market was actually in an accumulation stage in a while, because from this region over here down to this region over here, the market was in a range, somewhat like an accumulation stage. And all of a sudden the market broke higher. So currently we can totally agree with each other that the market is in an advancing stage, because after an accumulation stage, the next stage is what? The advancing stage. So the strategy we're going to be applying towards the market now is towards the advancing stage strategy. So we're going to be looking to trade pullbacks or breakouts. You want to say good. So we will likely ignore this stage here, because based on what the facts we have on ground, what we see here is an advancing stage. So this market could break and move forward higher. Are you going to say? So this is how you identify the market structure using the area of value. So since now we've clarified the areas on our chart, we can agree with each other, okay, now that the market is in an advancing stage, because this market can break forth higher. The only point that this will invalidate our fact is if this market breaks down lower to this region over here. You want to see? So then our fact, our bias is wrong. You want to see? They will now start looking towards, okay, we're actually in a distribution stage. But for the lower time frame traders, like those trading the 4 hours, the 1 hour, you can regard this area here as a distribution stage in the market. Are you going to get what I'm trying to say? You can regard that as a distribution stage. But for those of us trading the daily time frame, the weekly time frame, the 4-hour time frame, and the higher time frames, this is an advancing stage. I want to say right here on the daily time frame. So the bias is towards the advancing stage. So let's get back to class and conclude the analysis. So moving forward, since we've identified the market structure, the area of value, now we'll be looking on how to enter the market. Is that also? Now we're looking at how to enter the market. So now which leads us to the next part of the formula, which is the entry formula. At this stage, we'll be looking to identify the entry levels in the market, and we're going to do this using candlestick pattern. For those of you that don't know about anything about candlestick pattern, you can check our previous video right here on this channel. We dealt a lot on candlestick patterns, and there's still more to still cover up on the candlestick pattern, but you can check out the ones we have offered here on this channel, and they will help you identify candlestick patterns very well. So now we're going to be identifying candlestick patterns like the bullish engulfing, the bearish engulfing, the shooting star, the piercing pattern, etc., etc. So now let's get back to that chart and see if we could identify any candlestick pattern. So like now, while the market was in an accumulation stage over this region here, we figured out that before it broke out this region, before it started this advancing stage over here, if we zoom out on this chart here, we could likely see over here, what is known here as the bullish engulfing pattern over this region. Could likely see the bullish engulfing pattern over this region here. I want to say, so for those of us looking to go long on this market, once we see this kind of pattern over here, it's a signal that we have to go long. Even while it broke out of this lower region over here, it broke out and retest. We can also find here the bullish engulfing pattern, telling us, okay, now that it is time to go long in the market. So what we're going to do, we're going to place our stops over below this region. I don't want to say below this region here, below this region, and enter the market buy as it moves upward. And you see actually the market went upward before hitting this area of value over here. You want to see? So if we zoom out over here, if we're looking to enter this market forward, we'll be expecting the markets to break out over this region, forming a bullish engulfing pattern, or more like a shooting star pattern that will tell us, okay, the market is ready to buy or go long further. Are you getting what I'm trying to say? So we're looking for more a bullish engulfing pattern. We'll be looking for a bullish reversal pattern at this region over here, or at this breakout over here that we're expecting, because now the market is currently in a range, which for the lower time frame guys is a distribution stage for them. But for we trading in daily time frame, we'll see it as an advancing stage. So we're expecting this market to do something like breaking out over this level to this region over here and advancing forward, or reversing lower and creating a bearish reversal pattern instead. Then now invalidating the advancing stage which we have predicted earlier. Are you trying to see? So with that said and done, let's get back to class. The next thing on the formula is the exit rule, which is known as how do we get out of the market. You know, most time we pay more attention to entering the market without knowing when to exit. So now I'm going to covering how to exit the market. You're going to exit the market based on the four levels I identified. There are other levels, but these four levels are more popularly used and popularly known, and the ones you can easily start with. You can exit the market with a break of structure, with you can exit the market before an opposing pressure steps in. You can exit the market by trailing your stop loss. Then once it invalidates your stop loss, then you get out of the market. You can also exit the market with a Fibonacci level. So I'm going to be explaining few of them, like the break of structure and the opposing pressure. Good. So now, mind you, there's exit if you are wrong and exit if you are right. I didn't say that earlier, but I'm saying it now. There's an exit if you are wrong and exit if you are right. Exit if you are wrong, to not lose all your capital in the market, you set what is known as the stop loss. For you to exit when you're right, you need to set what is known as the take profit, and you set that take profit before an opposing pressure. So at this region over here, you can set your take profit over this region here. So if this market breaks out to this region here, you can take it at a breakout or continue riding the breakout by trailing your stop loss. I don't want to say. So this is how you exit the market. But if you are wrong and you enter the market at this region over here, and this market breaks down lower, it hits your stop loss and cuts you out of the market with just the minimal loss or which you used to enter the market. So with all this said and done, let's get back to class. So mind you, you can exit it as break of structure. Okay, let me just explain break of structure before I round up, before I go to the summary for today's class. Let me just go down to this when I explain break of structure. Okay, now we can see at this region here. You can see at this region that there's a bullish engulfing pattern over here. So this bullish engulfing pattern broke up higher. We're going to see hitting this level over here. We're going to see, so for a break of structure, we're going to say, for me to continue riding this trend, I need to see a lower high. You're going to see, I need to see a lower high in this market. But what we see here now, it's more like a reversal pattern that broke us out of the market. So that's why setting your stop loss over this region is going to be very good. But mind you, if you set your stop loss over here now and it hits it down, you've lost entirely in the market. So the moment where we saw that the market broke here and creates in a bearish reversal pattern, like a bearish engulfing over here, it's high time you exit the market. Honestly, it has high time you exit the market, because this is an invalidating of your setup, is an invalidating of your structure. Because for an uptrend, you're expecting for an uptrend, you're expecting a higher highs or higher lows to show that, okay, it's in an uptrend. Like here, like this, in this range markets, for this range market to show that it's in a downtrend, you expected, okay, the lower, at this region, there was this lows, highs, lows, then now high that broke the structure. So this shows us, okay, this is a downtrend in a range. I don't know if you're understanding me. If you don't understand, just leave your comments in the your question in the comment section below. I'll be sure to answer you precisely. So now at this region here now, where it was about going bullish, we experienced a bullish engulfing over here, a doji, then a bull bar with a momentum move. So we enter, and now there's a bullish engulf here. We continue, but at this point when we encountered a more like a bearish engulfing, it's high time we exit the market. But for some traders, for an experienced trader, you can wait a little while, because most times a bearish engulfing pattern may not invalidate the structure. But once we have something like this, looking like more like a reversal pattern, this is a bearish reversal pattern, joining itself to this bullish bearish reversal pattern, to this bearish engulfing pattern, it shows that, okay, this setup has been invalidated. This is no more a higher highs, higher low pattern that shows an uptrend. So this is an invalidation of our setup. So what we're going to do, we're going to exit it even before it's reaching our stops over here, our stop loss over here. Are you understanding what I'm trying to say? But if we're using the before the opposing pressure comes in, what we're going to do is that we're going to set our take profit at this level over here. We're going to set our target, because if you go down to this region, you see that the market reached this level. So that's why we drew this resistance over here. So what we're going to do is that immediately we saw this bullish reversal pattern, this bullish reversal pattern over here, yes, the bullish engulfing. we enter and we set our take profit over here. So once we hit our take profit, we take our profit in. We're going to say without any loss. So this is how to exit the market if you are right and if you are wrong. So if you are wrong, you use the break of structure to exit. You want to say if you are right, you use the take profits and before it the opposing pressure steps in. You want to say to exit. The other ones, the Fibonacci and the other level, I'm going to that's the trading of stop loss. I'm going to explain it in subsequent videos right here on this channel. So if you have any question, maybe you need some clarity in some areas that you don't understand on this particular topic, you can just leave the comments down in the comment section and I'll be sure to attend to you very shortly. So now, so that's said and done, we've come to the end of today's class. So before you enter any trade, make sure you pull out the May formula, the market structure. You can write it down in any book or jotter. You can pull it at one side of your screen if you have a sticker note on your screen. The May formula identified market structure, area of value, entry, and exit level. So mind you, the exit level have to do with when you're right and when you're wrong. So you need to plan this ahead. So this is just a formula you need to use to approach the market, to analyze. Mind you, I said it's a start to finish analysis. You want to say on how to identify markets you should trade and not trade. You want to say. So the next thing you're going to do, you're going to identify the market structure, the area of value, the entry, and the exit level. So mind you, I said I promised you a bonus tip on what we're going to do right here on this channel. To enter the market more precisely, you have to look out for pullbacks and breakouts. You have to look for pullbacks and breakouts. I'm going to explain that shortly. You know, I said there are various ways you can enter the market. Good. The market was in an accumulation stage over this region. Good. And it broke out of this level, of this resistance level now, showing, retesting this resistance level, now turned support. Now this resistance level now has turned support. Good. So it rested there. This resting, if you look closely, you will see, let's get that back. You'll see at this retest over here, you see a bullish reversal pattern showing us, okay, that the bulls are gaining power and momentum in the market. You want to say that what that bullish reversal pattern, known as a bullish engulfing pattern, the candlestick pattern there. So now, with this understanding, this retest here is known as a pullback. So for those of us looking to enter this market using this pullback strategy, what we're going to do is that if we enter this market at this pattern over here, what we do is set our stop loss at this region over here and set our take profit at this region over here, because we are not sure if the market will break out of this resistance over here. I want to say we're not sure if the market will break out that resistance, so we just set our take profits over here and set our stop loss at this region. So if the market reach here, which it eventually did, we're going to cash in our profit. But if it doesn't, we'll take the loss at this region over here. So this is how to trade a pullback strategy. Then to trade the breakout strategy is what we saw here. So now the market actually did rally upward and came to this region here. So you see the market broke out of this place and retested, creating this bullish engulfing pattern also over here. So this is also a very good strategy to enter. But since due to the way we drew rather our resistance level, so we're going to wait for the market to continue higher. So it did continue higher, creating this momentum candlestick over here. So what we do, we enter this place here. We enter this region, this candlestick over here, setting our stop loss over here. I'm telling this, mind you, this for the breakout strategy. Setting our stop loss over here and setting our take profits over here. Mind you, we had identified these levels earlier before now. You want to see? So we'll be setting our take profits over here for if the market goes in our favor. But if the market rejects us or decide not to go in our favor, to cut our stop loss over here. So this is how to trade the pullback and the breakout strategy. Mind you, I'm going to do a focus on the pullback and the breakout strategy later on this channel. So with that all said and done, let's get back to our class. So that's all for today's lesson. If you don't understand anything, please don't hesitate to leave a comment or your question right there, and I'll be sure to attend to you in a jiffy. Thank you for watching today's video. See you in the next videos.